doing our Hurley Investments Market View commentary for Monday, January 26th. It's almost also my son's birthday, which we just got off call with him. So it's always a fun day for me. This week is all lined up to be kind of exciting, I hope. We'll see what happens, but we have the FOMC meeting on Wednesday, and it's probably, just like Kevin says, I think I agree with Kevin on this. I don't think the Fed's going to do anything. I think that it'll be more of the same Fed that we've heard, unless Powell decides to stick it to the man and say no more cuts until he's out of office. I don't think there will be any fireworks going on, but the market tends to hold its breath and wait for a little while until they know what the Fed chair is going to say. And it's not whether they raise or lower rates that's as important as whatever the Fed chair says in his meeting afterwards. That's what's going to be most important and what we're going to be watching. So we probably won't see any action unless there's earnings surprises or things like that that happen before the Fed meeting. And then maybe we'll see some fireworks after that. We have another thing going on this week, the Department of Homeland Security funding issue. There's Democrats that are saying we're not going to fund the ICE guys because they keep shooting people. We'll see how that plays out, but that could lead to a government shutdown this week. So that's another potential thing that could cause some fireworks in the market. And just in case you're worried, I just know that we love fireworks, right? Fireworks get the market moving, whether it's up or down. We really don't care. We just want the market to move, and we want it to move big. If it goes big to the downside, we're protected. Our positions are protected for earnings, and we talked a lot about that kind of stuff last week. And I got to tell you, we on Meta. Oh my gosh, I'll pull up this chart here on Meta. Here's Monday when we talked about everything last week. Here's Tuesday where we executed the trade we talked about last week on our stock replacement program. We bought back the short call that we had that was way out of the money, and we increased the number of calls that we purchased. We doubled up on that, and boy, this just really is nice to see. That's a huge payout right there. So if you guys saw that, that's something to really be happy about in your account. I think the market's up about 1% as of this year, and we're up probably 4 times that amount. So in most of our accounts. So that was really a really nice thing that we just hit it spot on. Love to brag about stuff like that. And then Kevin said something last week. So we were talking, he showed you some images right here of the Micron trade, and he was talking a little bit about Micron being up, yet some of these positions were down. And he didn't really have time to go into depth and explain. So I get to explain it now because this is my area of expertise. So we had options. The stock was going up. We had bullish positions in these stocks here with the stock replacement program that we're doing, which is a debit spread. We buy a call and sell a call further out of the money. And these things were pretty deep in the money or deep out of the money, depending on which position you had, because we had quite a few of them out there. And some of them lost money, some of them made a little bit of money. And so the reason why the stock goes up big, it has to do with volatility. And I want to show you that here. So volatility, you can see right here, this volatility, this is the implied volatility, and the red line down here below is the average. And when we're looking back in time, we look at historical volatility, and it's just a statistical calculation that says how big are the moves in the stock. And implied volatility looks at an options price and says, how big of the moves is the market expecting in the future based on the price of the options? And so we had this nice big run up here, and volatility's staying kind of high here. And that's why we're seeing situations where the stock could move up and you're losing money. It's because implied volatility is rising, and it rises faster. So it rises faster on options. So this is a bell curve. So if you've ever done statistics in college, you've probably seen the bell curve before, and you've probably heard of teachers grading on the curve and all that kind of stuff. So this is the curve, and this is the expectation. The green line represents a log normal distribution that is expected by most option pricing models. They have some fat tails models and other things like that, but what this software is, software created by Don Fishback, my old mentor, he's just brilliant in option pricing, and some of you guys know him. And this blue histogram that's underneath is the way the stock price was actually distributed in the past. And so this is looking back over a 4-year period and saying this is what the distribution looked like. The green line is saying what the market's expectation is if it follows the price of the model. And so you can see here in the middle, that's where most everything is. So whenever you take an option trade, you put an option trade on, you need to find somebody who completely disagrees with you, right? And because they've got to be willing to take a risk when they put on the trade to go against you. They've got to be equally convinced that you're wrong and they're right. So when volatility is increasing, it means the demand for options is going up. Well, what if there aren't any buyers out there, or there's no sellers out there that want to take the opposite side of your trade? You kind of have to entice them to enter that trade and take on that risk, right? And when you look at this probability curve, I want you to think about the options that are down here. If a call option down here would be in the money. So the further in the money something goes, the smaller the time value is going to be. And the reason why is because it's kind of a sure thing. And you have to, if you want to sell that option, you have to get somebody and convince them to buy it. And you have to give them enough of an incentive that they want to buy it from you. Or if you just want to exit the position, you still got to get somebody to buy the option off of you. And so when it's out here, the probability of that finishing in the money, you can look at delta. I don't know if you guys have been taught about delta a little bit. Delta is it's a value that has multiple uses. The easy way to explain delta is to say it identifies what should happen to your option price if the stock moves up $1. And so you'll see here this is a chart from Thinkorswim, our table. All these deltas over here on the call side are always positive. And that's because if a stock moves up by $1, it should be positive for every option that is every call option that's purchased. The value should go up. And put options are always negative delta. And that means if the stock goes up by $1, you should lose money on a put. And so it's kind of giving you an idea of what the change in the price would be if the stock moves up $1. Now, this can also be taken as a probability value, and you can think of it in terms of probability as what is the probability of this stock finishing in the money at expiration? What is the probability that it will have value at expiration? So the further in the money something is, the higher the delta will be. And when you get really in the money, you can get to the point where it's like a dollar for a dollar, you're gaining value on that option when it goes really deep in the money. But there won't be a whole lot of time value on there because nobody really wants to spend all that, not nobody, but people usually don't want to spend a lot of money to enter when they're buying an option trade. They want to get the best bang for their buck, and they're going to pay a lot less if they buy an at the money option, and they'll capture all the value as the stock moves up from where it is right now. Now, the probability in that situation is usually 50-50. The stock, when you buy the stock, it's a 50-50 bet that it's going to go up or it's going to go down. But with an option, if it's 50-50 here, if the stock goes up $1, if it's at the money, you're typically going to make about 50 cents on that first dollar. Now, the next dollar would be a little bit different because it's further in the money. So this value just kind of gives you a probability-based value of whether the option is going to expire in the money or out of the money. Down here, when it's a negative value, you just, if I'm doing high probability trades, I'm typically looking for -10 because I want to do a high probability trade that's really unlikely. There's only a 10% chance that that stock is going to, that option is going to finish in the money. And so we have all this stuff, and it helps us just identify things. But when we look back at these, trades here that were negative as the stock was moving up, it was because the option that was at the money had a higher implied volatility than the option that was deep in the money, right? And so while we make dollar for dollar on these that are in the money, it doesn't have as much time value as the one that was closer to at the money when we looked at this last week. And so if you look on this side, you can see in this particular case, it looks like the options that are up here, they're lower probability of finishing in the money. And these are higher probability of finishing in the money. But the ones that have the biggest bang for the buck are always at the money options. And so when you get in a situation where this one's deep in the money and this one is right at the money, when implied volatility goes up because expectations are earnings are coming up or something, big could happen here really soon, then the one that's at the money gains value. And if you sold that one, you're going to lose a little bit more money than you would make on the one that's deep in the money down here. So does that make sense? Did I explain that well enough? Let me know if you have any questions. Thank you, Maud. All right, good. Yeah, if there's any questions, please type them and let me know. Because it's important to understand this kind of stuff, just because it helps you in knowing where your best value is when you're buying these options. And you'll see when we're doing these roll-ups and stuff. And the reason we were able to roll up on Meta last week and hit that so good is because the deep out of the money option lost enough money from where we sold it that we were able to buy it back for a far cheaper price. We made about $22,000 on that one, and then for that we could just buy double the number of contracts that we owned and just beef it up without taking on any more risk in the trade. And it just gave us a great upside potential on that trade as it bounced back. So that's what we're looking at there. That's all that I have on that topic, unless anyone has questions. Let's see here. Do you have an indication that Meta was going to move up? If it had not, then would you have just waited? Yeah. So we did. So we had this position on, and it's just a bullish position. And not only that, we were paying for that position with profits that we had already taken on owning Meta stock. it's funny to say Metastock because Metastock to me is my software program that my old person that old company I used to work for. But Metastock, we took profits off of that and we switched to a stock replacement program because we had a feeling that the stock could keep going up, but we didn't want to have as much money at risk. And so we used the stock replacement strategy. And then when we did this, it lost money. And when we do that stock replacement program, that option that we sell, that is our protection on the stock. And so in this case, what we did is we just, it became so cheap, it was too far out of the money to really offer a whole lot of protection. And so we cashed out like we normally do if we had a Meta put and we owned the stock and the stock went down enough, then we would cash out on the put and buy more stock shares. And that's what we did in this case. So yeah, so Nathan was asking, let's see here. Yeah, so when we do, a couple questions came in. So let me just go back to this graph here real quick. Nathan, yeah, so when these options are out of the money, because the probability of success in buying that option is low, it has less time value on it. You don't need as much money to somebody who's buying it. There's plenty of people out there that will sell it to them, and covered calls are the most popular strategy on the planet. So it's always going to be skewed, almost always, not always, but almost always going to be skewed so that the strike prices that are higher don't have as much time value in them as the options that are at the money. And so when we have a trade like Micron that goes deep in the money, when the option that we sold is at the money or close to the money, then the time value on that option here goes up at a greater rate than the time value down here, where it's highly probable that that's going to be in the money. So, and it just comes, it's supply, it works based off of supply and demand. And so when there's greater supply, the options get cheaper, right? Because they're looking for people to buy. When there's greater demand, the cost goes up. And so when people are worried about something, they start buying options. They're trying to get the biggest bang for their buck, and they usually buy those at the money options. And so that's where they get more expensive. The implied volatility of each strike gets a little bit higher, and you can see that. The implied volatility is, it's you can see down here, it's pretty close to the same all the way down. There's implied volatility over here. Yeah, it's pretty close to the same all the way down here, but it affects the price differently because of its relationship to where the current stock price is. And that's just how the model it works. Let's see. Yeah, so if the stock mod, yes, if the stock had not gone up, then that trade could potentially go to zero. But we had a lot of time on those, so and we expected the stock would continue to go up. And again, we were playing with house money, and it wasn't a large percentage of our accounts, and so it made sense for us to do that. And in this case, we were right on it, and we looked brilliant. That trade just did fantastic. All right, so earnings coming up here. We've got Apple. Let's see, that's on Wednesday. So we've got Apple and the Fed meeting on Wednesday. Boeing's tomorrow. AMC or the Meta is on Wednesday as well, after the market close. So we've got a few earnings that are coming up, and that Meta one could be a big hit. So we'll see. We've been talking about whether or not to put on some put protection tomorrow for that. We'll see. We're discussing it to try and see what we want to do before that earnings call comes out. we think it'll probably be good. That's our estimate, is that it'll probably be good. The big picture this week is, yeah, it was an excellent trade, Mod. The big picture this week, the housing market. This is something I totally believe in. I like. So here in Utah, some of us, you guys that are in Utah know this, but there's not enough there's not enough housing. It is really, we are really tight. We have shortages. Our state will give you $50,000 if you build a new home to pay off your down payment or whatever towards your house. They'll give you $50,000 towards your house to try and make it more affordable and to get you to buy new houses rather than existing ones, because the supply of housing here is really low compared to the demand. And that's the problem. And so this big picture, I totally agree with it. It's not about the mortgage rates as much as it is about the lack of supply. And things, when supply is low and demand is high, prices go up. And even if you bring rates down, what they're a little bit worried about is if we bring rates down to the point where people want to start buying houses, that just makes demand go up even higher, right? And so the housing prices could inflate even more. But this is a good article, just talking about housing prices. And it's just a problem with supply. I totally believe that is an accurate article. If you look at the big picture there. Where will the S&P end this month? Last week we said it was going to be up 1%. Well, it's there. Close today it's up 1.4%. Where will it be at the end of the month? So this week, really the last week of trading going on here. So we've got the Fed meeting that we'll hear and find out, and we'll see what volatility happens on Thursday and Friday. If the news is expected and things go as well as everyone expects it to, then it could shoot higher, and we could do better than 1%. If it goes down, it could. If the news is bad, then it could go down, and we're protected, so we're going to be okay. What goes into your discussion when deciding on put protection on Meta? A lot of it is cost, and the likelihood. It's cost and probability. So we evaluate those things and make decisions based on that. So, and we're all going to be talking in the morning. We're going out to lunch tomorrow too, to make sure that we make good decisions on that. And we'll let you know what the decision is next week. Actually, you'll probably find out when we do it in your account. Things coming up this week. Today there were some stuff that didn't really cause too much of a deal. Today's news was mostly based on the Minneapolis shootings and what the Democrats wanting to defund ICE, and the Department of Homeland Security, and the Republicans are saying, you want to close down the government over that, and we'll just see what happens. Housing prices come out tomorrow. Consumer confidence, new home sales, manufacturing stuff. Wednesday's the big day because of the FOMC announcement. That's really the most important thing. The other stuff probably be inconsequential compared to whatever the FOMC, the Fed chair, says at 2:30. That's what we'll be really watching. Thursday, jobless claims. A lot of these are delayed reports that are coming out, and the Fed balance sheet. And Friday, we've got one Fed governor speaking, and PMI and PPI. That's farm prices. That's it. Any questions about anything? JP, I will reach out to you. My website's got all my contact information, brianstrain.com, and I will reach out to you and let you know. Yes, good question, James. Do we have concerns about the capital markets in Japan affecting US markets? Yes, I do. Um, the good news is that we're protected. So as long as there's a big move, I love, a lot of people don't like volatility. I mean, if you think about indexing and how popular, there's more stock indexes on the market right now than there are stocks. And that's, so the reason to index is to reduce volatility in your account. And when our strategy makes seriously good money when we have rising volatility in the market, whether it's up or down, we really don't care. And I don't think Japan's going to ruin the U.S., but could it affect things here in the U.S.? Absolutely, it can. Yeah, and that is something that we are watching. Yeah, and which is another reason to make sure that we have puts on Meta if we're going to do that. It just depends on what we think is going to happen the next day. My preference personally is to have that protection on there. Definitely because we've got earnings and because there's some other stuff going on that could be potential catalysts to make the stock go down. And if we just buy an at the money put or even slightly in the money put, that could be really beneficial to us. So that's my guess, and I think that that's probably the way that we're leaning, but I'm not 100% sure. You're welcome, JP. Any other questions? Are you too late to buy in puts because you'll get volatility crush post earnings? That's absolutely a reason to not buy them tomorrow. That's one of the cons, right? When we're listing out the pros and the cons, that would be one of the reasons that we wouldn't do it, is because we're a little late. We looked brilliant when we pulled off the protection earlier in the week and doubled up on our call purchases. But if we don't have the protection, we get a big down move now. Could it go the other way? It could. But honestly, so typically when there's a nice big pre-earnings rush into the stock, sometimes that's prophetic, right? And you get a nice big pre-earnings push to the upside. It could be because everyone's expecting the earnings to be great. Meta's been not spending as much on AI, and so they'll be able to get a little bit more out there. What about putting on debit spread? Does that make sense? Potentially, yes. That's definitely another way we could do it. We could sell a call that's out of the money higher than where we're at, and simultaneously buy a put that will reduce our cost on the put that we're buying, but it also caps our profit potential. And so we'll look at the probabilities on that and the costs involved to see if it's a good decision tomorrow. That's a great question, and I'm really glad you guys think like this. You've been taught well. All right, I'm just giving a few more seconds here to give any more questions a chance. Thank you, Mud. I like that. I hope we always do a good job. All right. Well, if we don't have any more questions, I'm going to go ahead and let you get going. And we will be back with you guys next week. And keep watching your accounts this week. And we'll see what we get out of the Fed this week. You guys have a wonderful evening, and I will see you guys later. Thank you. Bye-bye.